All right, the closing print is finally in. And, if you only glanced at the headlines on your phone, you probably think the market just took a nap today. The S&P 500 finished effectively flat down a fraction at negative 0.02%. The Nasdaq composite, it shed about 0.15%. And the Dow was the outlier, actually grinding out a small gain of plus 0.11%.
Which sounds incredibly boring. It sounds like a nothing to see here kind of day.
That's the thing. The bell rang about 15 minutes ago, and on the surface, it looks calm. But I've been watching the internals all afternoon, and calm is the last word I'd use. It felt violent underneath. We're talking massive moves in individual names while the index barely budged.
It was a deceptively quiet surface, you're right. If you look at price action alone, you'd call it a choppy mess. But if we actually look at where the money was moving, the flows between sectors, this was a great rotation.
A rotation usually implies a healthy market, though. Swapping leaders, keeping the rally alive. But this felt different. It felt like hesitation or maybe nervous reallocation.
Well, context matters. We had market paralysis on the macro front today. We know the ECB and the Bank of England both held rates steady this morning. That gave us zero new catalysts globally. Everyone is effectively sitting on their hands, terrified to make a big directional bet before the January jobs report tomorrow morning. That 8:30 a.m. print is the binary event that dictates whether the Fed cuts in March or, holds the line. But beneath that paralysis, that wait-and-see surface, there was a massive shifting of gears.
Okay, so let's dig into that shift, because looking at my screen, shifting gears feels like a polite way of saying demolition for some of the retail favorite names. We have to talk about the narrative change here, because it feels like the whole vibe on Wall Street changed overnight regarding AI.
It is significant. The theme of the day, without a doubt, is the Capex cliff.
The Capex cliff, that sounds dramatic. Unpack that for us.
Think about the last 18 months. The entire market has been operating under this AI at any price mantra. You buy the GPU makers, you buy the hyperscalers, the Googles, the Microsofts, and you don't ask questions about the cost. You just assume the ROI is coming eventually.
Right.
That era, it's officially in the rearview mirror as of this afternoon. The market has decided to start punishing Capex overkill.
And the poster child for that punishment today was Alphabet.
Oh, absolutely. It was brutal.
I mean, looking at the ticker, GOEGL, this was a classic gap and crap, as the traders call it. It opened lower by 3%, tried to fight back for about an hour, and then just gave up the ghost. It closed at session lows, down 5.2%.
Which is a massive move for a company that size. We aren't talking about a penny stock here.
It's huge. I ran the math. That's $170 billion in market cap that just evaporated in a single session.
Oof.
Gone. And the irony is, it all comes down to their guidance on spending, right?
Precisely. The guidance involved over $180 billion in AI capital expenditure. That number didn't just surprise the street, it spooked them. Institutional desks are looking at that spreadsheet and saying, okay, we love the potential of AI, but we are no longer rewarding that potential if the cost of entry is destroying balance sheet efficiency.
It's almost like the market is suddenly asking for a receipt. They want to know what they're getting for that $180 billion.
That's a great way to put it. It's a return to discipline. You saw money swapping lanes. It didn't leave the market entirely, and that's a key distinction you need to understand. But it aggressively left spend-heavy tech and moved elsewhere.
Well, let's talk about where it went, because while tech lagged, down 0.6% on software selling pressure, the energy sector was actually leading the day, up 1.1%.
Energy is the classic hedge right now. We had Brent crude surging on those renewed Middle East supply concerns, so there was a clear, logical place for that capital to hide. It's tangible. It's real assets versus digital promises.
Real assets versus digital promises. I want to stick with that digital side for a second, because it wasn't just Google taking a beating. We had a technical breakdown in Qualcomm that was just ugly. And Qualcomm is usually seen as a stable hardware play, isn't it?
Usually, yes, but today was a disaster for the semis. And if we connect this to the bigger picture, Qualcomm is telling us something worrying about the hardware cycle.
QCOM opened down 6%, and then it just cascaded. It finished down 9%. And I've seen some sources pegging it closer to a 10% loss by the final print. It smashed right through the 200-day moving average. What is the specific fear there? Is it just the Capex thing spilling over?
It's more specific than that. The narrative is shifting toward a memory shortage headwind.
Great shortage, usually in commodities or tech. Shortages drive prices up, which is good for suppliers. Why is the stock down 10%?
Because in complex manufacturing, a shortage isn't a pricing power opportunity, it's a bottleneck. We've been worried about demand for phones and PCs, but now we're worried about component supply bottlenecks again. If you can't get the memory chips to build the device, you can't sell the device. So Qualcomm gets hit because their chips can't go into phones that aren't being built.
Got it. So it's the supply chain paralysis.
Exactly.
Mhm.
And I think there is a deeper, more psychological element to the tech sell-off today. It wasn't just hardware logistics. It involves Anthropic.
I saw those headlines crossing the tape. This is regarding Anthropic's new automation tool, the agentic AI.
Yes. And this raises a massive existential question about who actually benefits from AI. The headline regarding this new agentic automation tool caused a legitimate sell-off in SaaS software as a service, and specifically legal tech. And we saw that bleeding into financial services too.
Why specifically legal tech? I would think lawyers are safe.
Well, think about what a junior associate at a law firm does, or what expensive legal discovery software does. It reads millions of documents to find a needle in a haystack. This new tool from Anthropic claims to do that autonomously, faster, and cheaper.
So the market is looking at these legal software companies and saying, you're obsolete.
Exactly. The market is starting to punish companies that are vulnerable to displacement. It's not just buy AI stocks anymore. It's sell the companies that AI is going to replace. So you have this double whammy. You're selling the big spenders like Google because they're spending too much, and you're selling the software companies because their product might be dead in 5 years. That is a toxic mix for the Nasdaq.
That's a terrifying pivot. It goes from AI helps everyone to AI eats everyone.
Mm-hmm.
And just to cap off the risk-off vibe in that corner of the market, I have to mention Bitcoin. It slipped below that psychological $70,000 handle. It seems like as liquidity tightened up today, crypto just caught the cold immediately.
Crypto is what we call the highest beta asset.
Let's define that for the listener who might just be holding some Bitcoin in a wallet. When you say high beta, what are you signaling?
Beta is essentially a measure of volatility relative to the overall market. If the S&P 500 sneezes, a high beta asset gets the flu. When equities move into a risk-off or defensive posture, liquidity dries up in the riskiest assets first. Bitcoin is the canary in the coal mine for risk appetite. If Bitcoin is puking, the risk managers at the big hedge funds are nervous. They are pulling chips off the table.
So we have the narrative, we have the Capex cliff, the AI anxiety, the crypto wobble, but I want to verify this with the internals because sometimes you get a noisy day that looks scary, but it's just retail panic. You know, mom and pop selling because they saw a scary headline. Was today real?
That's the most important question. And looking at the data, this was absolutely real. This was a high conviction distribution day.
I'm looking at the volume numbers to confirm that. Total volume across the combined tape was 24.60 billion shares. Now, to put that in context for you listening, the 30-day average is only 19.90 billion. So we are talking about a day that was 23% above average in terms of activity.
Which tells you this wasn't retail. Retail doesn't push volume 23% above the trend on a random Thursday ahead of non-farm payrolls. This was institutional. This was the big boys, pension funds, mutual funds, sovereign wealth. This was a degrossing of the AI trade. They faded that early bounce in tech. Remember, we tried to rally in the morning, and then they aggressively sold into it.
But they didn't just go to cash, did they? We talked about energy, but let's talk about buying the close. Because while Google and Qualcomm were getting taken to the woodshed, there was a massive buy-side imbalance in consumer staples. We saw the XLP sector catching a huge bid.
It's the flight to quality. When the world feels uncertain, you buy what people need, not what they want. And we had a perfect example of that counter-narrative with Hershey.
HSY, right. That chart looked like it was from a different planet today. It gapped up 8% on earnings. But what was impressive is that it didn't fade. It expanded into the close.
And why? Because they provided a rosy 2026 outlook. In a market that is suddenly terrified of Capex overhang and AI disruption, here comes a company selling chocolate with a stable outlook. It provided safety. We saw the same thing with Costco and Coca-Cola. Significant market on close buy orders. The institutions were effectively swapping their high beta tech exposure for reliable, boring cash flows.
It brings us back to that atoms versus bits idea. You can't prompt an AI to eat a chocolate bar.
Not yet, anyway. But yes, the defensibility of physical goods is becoming a premium theme. If you are holding a portfolio of high valuation software stocks, you need to look at them very hard this weekend. The real money flows are voting for physical staples over digital growth right now.
Now, there's one more divergence on the board I want to flag because it's weird. While software is under fire, the S&P Midcap 400, the MDY, is printing record highs. Why are midcaps surviving this? Usually when the big guys fall, they drag everything down.
That is fascinating, isn't it? It highlights that the bull market isn't dead, but the leadership is changing. Mid-caps are often more domestic, less reliant on global supply chains, and frankly, less bloated with AI hype. We are seeing a divergence between the average stock, which is actually doing okay, and the mega-cap tech darling, which is correcting.
However, you did flag a warning sign to me before we started recording regarding the advanced decline ratio. It's not all sunshine in the mid-caps.
No, it's not. The advanced decline ratio finished near 1.2 to 1. That signals exhaustion. Even though the mid-caps are high, the number of stocks participating in the rally isn't screaming broad rally. It's screaming desperate rotation. It's investors running from room to room trying to find a safe chair before the music stops.
And the VIX, the fear gauge.
We're hovering at 16.4. The 16 floor is holding. We've talked about this. Volatility isn't getting crushed anymore. Traders are paying a premium for downside protection. Even with the S&P near highs, the fact that the VIX refuses to break down tells you that smart money is hedging. They are buying puts. They are nervous about tomorrow.
Which brings us perfectly to the setup for tomorrow. We have the scoreboard, we know the volume was heavy, but now we need to look ahead. Tomorrow is Friday, February 6th, and it is all about 8:30 a.m.
It's the macro setup we've been waiting for, the non-farm payrolls report. This is the binary event.
Binary meaning it goes one of two ways. No gray area.
Exactly. It determines if the higher for longer interest rate regime stays alive, or if the Fed gets the green light to cut in March. If the number is too hot, too many jobs rates stay up, and tech gets hit again because their borrowing costs stay high. If it's too cold, we worry about recession. We need a Goldilocks number, not too hot, not too cold.
And remember, we have Amazon earnings tonight. By the time you hear this, those numbers will be out, but the market will be digesting that news right alongside the jobs number at the Friday open. So let's give you the map for the S&P 500, the SPX. We need to watch these key levels because the dealers are positioned in a very specific way.
Correct. The most important number on the upside is 6,900. This is the gamma wall.
Okay, pause. Gamma wall. We throw that term around a lot, but for the listener who isn't trading options every day, what exactly does that mean? Visualize that for us.
Think of it like a magnet or a force field created by market makers. There's a huge concentration of call options sitting at the 6,900 strike price. The dealers who sold those options are short those calls. As the price gets closer to 6,900, they have to buy futures to hedge themselves. That buying pulls the price up until we hit the wall. Then, because they are hedged, the buying stops and it acts as resistance.
So the hedging activity pulls us in, but the sheer size of the position makes it hard to break through.
Exactly. If we rally tomorrow, we likely get stuck or pin right at 6,900. It's a ceiling.
And on the downside, if the jobs number is bad and Amazon misses,
6,800. That is a psychological line in the sand. If we hold 6,800, we are okay. But the floor, the real danger zone, is 6,731.
that's a very specific number. Why? 6,731.
Technical trend lines combined with dealer positioning. If we break 6,731, the trend shifts from neutral to bearish. That opens the trap door targeting 6,550. And right now, dealers are short gamma below 6,850.
Short gamma, does that imply stability or volatility?
Accelerating volatility. If dealers are short gamma, it means if the market drops, they have to sell futures to hedge their books. Their selling makes the market drop faster, which forces them to sell more. It creates a feedback loop.
So below 6,800, things get slippery fast.
Very slippery. It's like stepping on ice.
So knowing that, what is the trade? If you're sitting there with dry powder, what is the high conviction setup for a Friday?
The high conviction setup is the Friday mean reversion. We've had this violent rotation today. We've had the tech flush. And this is a big if. The 6,800 level holds at the open. You look for a violent squeeze back to 6,900.
So you're playing the dealer re-hedging.
Exactly. You play the bounce. The specific instrument would be long SPX, 6,900, calls 0 DTE.
That's 0 days to expiration.
Yes. Options that expire that same day. They're high risk, high reward. Or if you want to short the tech weakness, you look at short QQQ 610 puts. You are betting that the selling exhaustion hits and dealers have to cover their shorts, driving us back to the magnet.
I like that. But let's talk about specific names for a day two play. We mentioned the bloodbath in Google and Qualcomm. Do we touch them tomorrow, or is that trying to catch a falling knife?
Watch lists are crucial here. For Alphabet, GOGL, watch $170. Day 2 usually sees dip buying if the primary support holds. So look for a morning washout, maybe a flush at the open where everyone panics, followed by a V recovery if $170 stands firm.
So let the panic happen, then buy the recovery.
Don't be a hero in the first 5 minutes. Let the dust settle.
And Qualcomm.
QCOM is trickier. It's broken technically. If it doesn't bounce in the first 30 minutes, you have to look for a flush toward $155. It's a falling knife until proven otherwise.
One final thing to watch on the dashboard.
The ratio we mentioned earlier, XLP divided by XLK, consumer staples versus tech.
So we're just dividing the price of the staples ETF by the tech ETF.
Simple math. If that line goes up, it means staples are winning. If staples outpace tech again tomorrow, if that ratio goes up, it's a confirmation of a multi-week defensive pivot. It means today wasn't a one-off. It means the regime has changed.
Don't blind buy the tech dip. Respect that 6,800 level. And watch out for the legal tech fallout. I have a feeling we're going to be talking about that theme for the rest of the year.
I think you're right. The AI victims list is just getting started.
That's a cheerful thought to end on. But hey, volatility is opportunity, right?
Only if you're prepared.
That's the bell.
Get to work.